Clapham. I'm the founder behind Balance Sheet, and I'd like to welcome you to another in our investing tips series of videos. You can read more about it on our website and if you look at the blog. Before I get into the video, what I'd like to just talk about is we do a fantastic newsletter which gives you all sorts of useful tips. You can sign up at behindthebalancesheet.com, where we also have some investing courses for private investors. Go check them out. We're on investing tip number 4 already, and this is about per employee measures. I'm a great believer in looking at valuations per unit of capacity. So if you're looking at a restaurant chain, I like to think about the valuation per restaurant. But not every business lends itself to this sort of metric. And as a consequence of that, you need to be a little bit more inventive. And one of the tricks that I use is to look at per employee measures. Now, this gives you an insight into productivity trends. It can often give you perspective on an acquisition. And sometimes it can be extremely valuable when you're doing cross-sector or intra-sector comparisons. Let me give you an example. This is Procter & Gamble's revenue per employee. And you can see that the chart was going up pretty well in the 2000s. So from 2001 through to 2008, the global financial crisis, things looked great. Productivity almost doubled. Look at that. Fantastic performance. And then things took a bit of a halt with the GFC. We then had a little bit of improvement, but not nearly as much as in the previous 10 years. And since that period, 2013, 2014, there's been pretty flat for 5 years, with a pop-up over here and a little bit better in the last financial year. Now, obviously, we're looking at a global multinational business denominated in dollars. So the currency will have a big effect in this. But one of the things that you can do here is you can think about the trend in revenue per employee can give you an indication as to what's happening in the business. And Procter & Gamble, excuse me, I got hay fever. Procter & Gamble, interesting company, going through a sort of rationalization process. It's been selling businesses, and obviously one measure of the quality of the business that's left, one measure of are they selling the good businesses or are they selling the lower quality business, is to look at this trend in revenue per employee. And what you can see is in the last 5 years, it looks as if the businesses that have been selling are lower quality, at least in terms of their employee productivity. So this is quite an important and useful measure you can get from using this sort of data. And, you know, management will very rarely tell you, I've never seen a management tell you that they've sold the crown jewels. But often they do sell the crown jewels, and so it's important to be aware of that. And this is a chart I've shown you from the Economist. And what you can see here is a bunch of tech and media companies evaluated on a per employee basis. And this is great because what you're doing here is you're getting a very calibrated like for like measure of how these companies perform. And who would have thought that a Netflix employee was 30% more productive than an Apple employee and 3 times as productive as a Microsoft employee? These are interesting things to think about. It's not that necessarily you're getting some hugely different view of the business, but I find these sorts of measures are quite thought-provoking. And interestingly, if you look at the free cash flow per employee, Netflix is negative to the tune of 120,000. Apple, $500,000 positive, and miles better than any of the others on this chart. And you're paying a bit more for an Apple employee, but by golly, they're delivering a hell of a lot more cash flow. So this is just a different way of segmenting the financial data, and it gives you a very insightful look into what's actually going on. And I think the bottom chart there is particularly interesting. AT&T, you're paying less than $1 million for an AT&T employee. That's not an awful lot of money. They're generating $700,000 of revenue. Okay, they're only making $50,000 of profit, but they're generating $100,000 of free cash flow. Well, obviously there's a good reason why AT&T's on such an attractive free cash flow valuation, but looking at it through the lens of how much is an employee costing, how much is an employee generating, I think is a very useful way of calibrating the financials in a different way. I hope you've enjoyed this. I encourage you, please sign up, get our newsletter, and do have a look at our courses. And don't forget to subscribe to the channel. Thanks for watching.